This is All India Radio. In the program Spotlight, now we bring you a discussion on RBI Monetary Policy Committee decision to keep the repo rate unchanged. The participants are K.A. Badrinath, Economic Analyst, and Rajesh Lake, AIR Correspondent.
Mr. Badrinath, what are the key highlights of the monetary policy meet of today?
The top highlights include that there has been no changes in terms of interest rates. That is the repo rate at which the banks borrow funds from the Reserve Bank of India. And this also determines for the customers as to what rates they pay for their home loans or personal loans or other things. So my guess is there is much of a relief that has come. And it's a welcome relief given that the interest rates have been in a big way pinching a lot of small borrowers, especially who go for automobiles or maybe the housing, that kind of.
So that's a positive side of it, that okay, for home buyers and all, the rate of interest.
It's a positive in the sense that it may not be the norm as such, because the inflation levels are still way too high to expect this to be a norm of pausing or going in for a reduction kind of, leave alone reduction. If we don't have further increases, that will be a big relief in the next 2 months when the Monetary Policy Committee meets again. But as of now, yes, there is a big relief that there is no further hike and we are going to stay at 6.5%.
So is this rate pause a reflection of extreme uncertainty?
Uncertainty or certainty levels that we are talking about, in the sense that many of the customers for the banks would continue to, at this point of time, pay 6.5%. Second issue is, if you see the policy stance, it continues, it has not changed as of now. So, there is likely that the Reserve Bank of India will continue to be withdrawing the accommodative levels, or easy policy stance will not be there. That means for the customers of banks and financial institutions, you cannot rule out further hikes. The Reserve Bank of India Governor, Mr. Shaktikanta Das, has clearly stated that we will come into action whenever and wherever required. That means he is saying that this pause is temporary and we need to be very carefully watching the headline as well as core inflation.
So, going by what you just said, so the increased global uncertainty, stable currency in 2023, and the incomplete transmission of the past aggressive rate hikes has all put together, have they prompted the MPC to take a short break in the rate hiking cycle?
In the last 1 year, beginning May 2022, there have been 6 hikes to the extent of 250 basis points, or the 2.5%. Well, those hikes sunk into the system or not is a big question everyone is asking. So let these hikes sink in first and play out properly at the retail level, then at the borrower's level. Then we can think of a next hike someday, number one. Number two, talking about the global levels, it is that you have seen recently that the Silicon Valley Bank has declared bankruptcy and Credit Suisse have bought it over. Credit Suisse has been picked up. So both these cases denote that there is financial volatility globally, and continued increases in the interest rates globally has also had an effect, sobering effect on the Reserve Bank of India. Third, the policy responses of most of the central banks globally has been different vis-a-vis what has happened in Reserve Bank of India, which is the latest move, has paused. If you see the Federal Reserve, European Central Bank and all over, they have been on an increasing side. And there have been arguments that we need to decouple our monetary policies vis-a-vis what happens with the Federal Reserve or European Central Bank or other central banks. Perhaps this is being attempted by the Reserve Bank of India, saying that India will take its own course on the monetary issue.
So what you're saying is the SVB or the banking turmoil in the banking system or the contagion effect, so to speak, is that the reason behind the pause? Because everyone is talking about how aggressive, the RBI had been, but suddenly there is a change in their stand, and we all are talking about a stand which is not very aggressive anymore. So what could be the reason behind that?
As I have said in the beginning, this is a temporary pause. He will look out.
A temporary hawkish pause.
No, may not be hawkish for the simple reason the stance continued to be not being an easy money policy. So it is not an easy money policy because the stance continues to be withdrawal of accommodative policy will continue.
Okay.
Henceforth, that means tightening will continue. That means he has not ruled out further increases in the near future. That is sometime in June when the Monetary Policy Committee meets again. But you're right. On some level, the contagion effect may have some impact on our banks, maybe playing out with the Monetary Policy Committee. As of now, our banks, both the public sector banks, private banks, foreign banks, joint venture banks and cooperative banks are well funded, stable, and there are no signs of collapse as of now.
Yeah.
But maybe this is a precautionary move as to see how this will play out, and perhaps it is giving the banks enough relief to see how they can readjust their loan books. Number one. Number two, for the customers, they have been feeling the pinch of the constant increase in the bank rates in the last 1 year, almost 11 months. So from there they will get a little relief in the sense that there is at least their EMIs will not increase every month that it goes out. That will not increase at least for the next 2-3 months, and it will remain. In case we can stabilize at 6.5%, it's nothing like that. But there are expectations that in the first half of this financial year, which ends by September 2023, there is likelihood of another 1 or 2 hikes. But once the policy stance takes effect, or the policy that has been taken now takes effect and goes well with the banks, perhaps it will be reviewed further, and then only the next action will be planned by the Reserve Bank of India.
But see, the embassy has also retained the flexibility to tighten policy at future meetings, which you mentioned, should high and persistent inflation warrants such an action.
Inflation levels as of now are not in sync with the Reserve Bank of India's expectations. Reserve Bank of India's standard is that you need to have 4% inflation plus or minus 2%. But as of now, if you see the February figures, February 23 figures, it's 6.44%. But the Reserve Bank of India wants that during the end of this financial year, it should come down to 5.2%, which is more comfortable both at the level of your budget making, your spending, and as well as consumption levels. Needs to be managed because of which is directly linked with the cost of funds in the market.
So what I hear you say is that the war against inflation is still not over, and rather RBI wishes to wait and watch how the situation pans out amidst, and these are the threats that we have of El Nino. And we also have the global banking turbulence, which we talked about, the OPEC production cuts and the geopolitical tensions. In light of that, the wait-and-watch policy that the RBI is taking.
My guess is it's a pause and not a pivot, in the sense that it is not going to dictate a trend of next few increases or keeping it at the same level. But my guess is a review, an objective review will happen definitely in June when the Monetary Policy Committee meets again, and we have to just look out in the next 2 months as to how this decision of the Reserve Bank of India would work, and also see the consumption levels. Mind you, the Finance Minister, Madam Nirmala Sitharaman, had put a lot of money into the infrastructure sector, almost 10.5 lakh crores. Then if you go with the railways, another 4 lakh crores. It's almost 14-15 lakh crores of the 45 lakh crore budget which has been put into infrastructure development. In case this takes off in a big way, as everybody expects, and also, mind you, already your credit growth has been very healthy in the last 1 year. And if this momentum continues, then perhaps the Reserve Bank of India will have a positive way to look at or review its stance on accommodative or tightening policy stance, which will dictate your interest rates going further.
So what about the rate-sensitive sectors? They are already showing the impact of the monetary policy, and the central bank expects to have the CPI inflation at 5.2% by the end of the fiscal year. So that is also going to have a repercussion on the CPI inflation.
Right now, the consumer level retail inflation is much higher at 6.44. So that he may like to bring it down. And also mostly the vegetables and fruit related inflation during summer will be, because the consumption levels will come down, because the cost of these fruits and vegetables will be much, much higher. Number one. Number two, the consumption also needs to be managed somewhere going further. You cannot ditch the growth projections, because also the Reserve Bank of India governor talks about having a 6.5% growth, whereas World Bank and IMF are saying there could be moderation in the growth in this financial year. So we need to think about how all these four factors, the interest rates, the inflation, then the growth parameters, and how your consumption levels will work. These are the four big parameters based on which the Reserve Bank of India is likely to take its stance further in terms of interest rates, in terms of inflation levels. Though right now he says that it will be 5.2%, as you rightly said. In fact, it was earlier projected to be 5.3%, and that means he's thinking that the pause in the interest rates is likely to have a sobering effect on the inflation levels as well. And it will be a big relief, because your interest costs are lower, the cost of goods and services are likely to come down. The third is the consumption levels are likely to go up. That means your economic activity is going to be much healthier in terms of turning around.
So how much are we influenced by the US Fed's action? RBI governor has said, and I'm quoting him here, India's monetary policy is determined primarily by domestic factors. So therefore, we were never really coupled with the US Fed actions.
There have been suggestions. I would point out that we have been more or less in sync with the Federal Reserve as well as the European Central Bank's monetary policy standards that they have taken till now in the last 1 year post-COVID. In the last 11 months, we have been doing. If you recall, many of the economists have said there should be a decoupling in our money policy vis-a-vis vis-a-vis Federal Reserve and ECB and things like that. Even most of the economists within the country and outside think that since India being seen as the brightest spots in the world for economic growth, not only within the country, but having implications for world growth levels. So if that is the case, we need to decouple from both the Federal Reserve and the ECB. Perhaps this is first indicator of decoupling ourselves from the most of the central banks globally.
Thank you so much on that positive note, Mr. Badrinath, for being with us on All India Radio.
Thank you.
You were listening to a discussion on RBI Monetary Policy Committee decision to keep the repo rate unchanged. The participants were K.A. Badrinath, Economic Analyst, and Rajesh Lake, AIR Correspondent. This program was produced and presented by the News Services Division of All India Radio. You can listen to it on our mobile app News on AIR. This program is also available on our YouTube channel, News on AIR Official.